let's talk about so much that has happened, and we all know about the inflation report that came out last week, and then again on Tuesday, we saw another report that suggested that inflation is really sticky. And of course, then on Wednesday, the Federal Reserve came out and raised the short-term interest rate 75 basis points. We did talk about it last week, Derek, that said, is it 50 or is it 75? Well, we now know the answer to that question.
Right, and earlier in the week, it would seem that the Fed was telegraphing that because they didn't really want to surprise the market, and clearly the Fed has decided, to follow the data. That CPI obviously disappointed them. The PCE measure, which they follow, isn't quite as hot as the CPI, but they did react to a very, very high print and are well on their way towards getting towards what the market expects, which is roughly a terminal rate on Fed funds of roughly 3.5%.
Yeah, so now we see they're trying to catch up to market rates. And of course, while they are raising rates, by theory, they're trying to slow down the economy. Well, apparently it's having its intended effect because we watched the GDP report. We reported widely that last quarter it was a negative report. We all know that back-to-back quarters are the technical definition of a recession. We looked at the GDP report for this quarter, and it is at a 0. Perhaps we're already in a recession.
That certainly may be the case. One other thing about the technical definition of a recession, yes, typically we talk about 2 negative quarters of real GDP, but there are also other factors that go into it as well, like unemployment and the rest. And unemployment is still sitting at 3.6%. So I would doubt the board would call it a recession with unemployment levels near those numbers. But the basic drift of the economy recently has certainly been towards softness. We saw weak leading economic indicators this week, retail sales, housing starts, and even initial jobless claims are no longer making new lows. So the economy is clearly softening, and that's really what the tug-of-war is going to be between slowing growth and the Fed raising rates.
A lot of times, Derek, you talk about the economy and the market are not directly connected, but the stock market clearly is reacting to a slowing economy.
Right. I mean, what I was saying the last couple of weeks, we don't want to conflate normalization of the economy with a recession. Clearly, the odds have risen that we could fall into a downdraft in terms of economic activity. But with the S&P now 23% from its high, you have to think a good amount of that has already been discounted.
Right. So you look at technical indicators, and we do that. Of course, we look at both fundamental numbers, and what are the numbers, and what is the technical, how is it trading? And we heard a lot of technicians this week, and again, let me just try to frame this out. The S&P is trading right around high 3,600, 3,700, somewhere in that neighborhood, and a lot of technicians are saying that there's a lot of support at 3,500, which is about a 5% down from here. In other words, that could be a bottom. We're certainly not trying to call a bottom, but there's evidence that there's some downside protection.
Right. And the other thing that I always look at is, there are a lot of sectors of the economy, small caps, for example, some technology names, particularly the higher multiple tech names, that have already been deep in a bear market, some down 60, 70% from their highs. And while I'm not suggesting they're going to go back to their old highs, oftentimes stocks don't all bottom at the same time. Even in March of 2020, many stocks actually started to bottom a few months before that panic low. So it does behoove one to really look around tactically for opportunities. As an example, one of the most beaten down sectors of all has been biotech, particularly small cap biotech. And even though the market was weak this week, the small cap biotech index did not make a new low, which I thought was sort of interesting.
Right. So you think about the market, air quotes, folks, for being on radio. Air quotes, the market generally is the S&P 500 or the Dow Jones when people say that. And sometimes it's the last one to bottom out. And what Derek is saying, instead of trying to call a bottom, is to approximate the bottom. In other words, trying to find it by picking off pieces one by one. And so if you don't have a plan to go forward from here, there's someplace I know that you can go to help you get there.